Hi guys, good evening and welcome back to another session with Star for Sample. All right, so if you've noticed, ever since we started entries, I've been saying, well, already starting what this is the beginning of the end, this is the beginning of the end, because actually it is so far from the very first class you had on candlesticks to the class you had on support and resistance to the class you had on market structure, demand and supply, imbalance, liquidity, the PDRs, this, that, everything sums up at entries, right? So far we've started the entries class. We've done the type A and type B type of entries. And I also mentioned that we have reclaim blocks as entries as well, right? And then I also mentioned when you would need structural liquidity for reclaim blocks and when you wouldn't need structural liquidity for reclaim blocks. Sorry. So in today's class, I'm going to go through everything again. But the major thing we're doing today is putting everything together. Everything you've learned from the onset up to these entries now, putting everything together. That's what we're going to be doing today, right? But then before I move to what we're supposed to do today, I want us to just do a quick recap on what we've done so far, right? I want us to do a quick recap on what we've done so far. So we're going to do, let me go to a random pair. This is USD. Let me just clear my chart. All right. Now, if you guys remember, our first important topic when it comes to the advanced side of this particular sample outline was market structure, right? And in market structure, we talked about the three types of trend, where we said that we have three trends, which is what the uptrend, the one that looks like it's going up like this, made up of what series of higher highs and higher lows. And we talked about what the downtrend, the one that looks like it's going down, made up of what series of lower highs and lower lows, just like this. And if you guys remember, we also established the fact that the highs in an uptrend are called what targeted highs. Targeted highs. Target means that they will be killed and replaced, meaning that price will always put in a new high in an uptrend, right? So you're anticipating that for an uptrend to continue, price must keep on creating what higher highs that are higher than the previous highs, and what lows that are higher than the previous lows. If you can see, this low now is higher than what this low. This low is what higher than this low. This low is what higher than this low, and this last one is higher than this low. But for the downtrend, we're having what the lows are the targeted ones. So it's just like the opposite. For the uptrend, highs are targeted. For downtrend, lows are targeted. You're anticipating that for a downtrend to continue, price has to what keep creating series of what lower lows, meaning lows that are what lower than the previous lows. You can see that this particular low now is what lower than this one. Here you have a low here that is lower than what the previous low. Here you have a low that is what lower than the previous low. This is how a downtrend is created. When price keeps creating what lows that are lower than the previous lows, and in an uptrend, price must keep creating what highs that are higher than what the previous highs. So if you notice the highs as well in a downtrend, you can see that the highs are what lower than the previous highs. This high is higher than what this one. So meaning that high 2 is lower than high 1. High 3 is lower than high 2. High 4 is lower than what high 3, just like this, right? And then we talked about the third type of market structure, which we call the ranging or consolidation market structure, which we established that just like price moving what in series of equal highs and equal lows, relatively equal highs, relatively equal lows. Price creating what series of equal highs and equal lows. So uptrend, higher highs, higher lows. Downtrend, lower highs, lower lows. The third type, which is the ranging or the consolidation market structure, equal highs and equal lows. And then we also did demand and supply zones where we talked about the two types of demand and supply zones that we have, where I mentioned that we have what? Something called a range created demand zone, where price is probably consolidating. Remember that we talked about consolidation market structure, right? So let's say price is consolidating just like this and then breaks out to the upside. It definitely what it has created a demand zone that broke out from a range called what a range created demand zone, right? And also, like you have in an uptrend, when price is moving in an uptrend, creating series of what lower highs and lower lows. The moment price breaks out now to put in a new high, it leaves what another demand zone at this area. This one is called what a pivot demand. So I said that we have what two types of demand zones, which is what the range created demand zones and the pivot demand zones. The same thing for the supply zones. Let's say that when price is moving in what in a consolidation way, when price is just consolidating like this and then breaks out to what to the downside, just like this, instead of to the upside now, it's going to create what a supply zone, right? This is what a range created supply zone. Or if price is moving in a downtrend, sorry, just like this, it creates what when it breaks to the downside, it creates what a pivot. It creates a pivot supply zone, just like this. And I told you guys that for every lower high in a downtrend, there is what a supply zone resting at the extreme. But that does not mean that those are the only places that you can find supply zones. Actually, you can find supply zones somewhere here. Do you understand? Supply chains are also found in between trends because of the internal market structure, right? But then you're sure that at every lower high in a downtrend, there is what a supply zone, and at every higher low in an uptrend, there is what a demand zone, just like this. And we also did validations for this demand and supply zones where we talked about the break of structure, making sure that your demand zones what break structure to the upside for it to be called a valid demand zones, the valid demand zone, sorry. And we talked about your demand zones being in line with the trend, which means that for you to spot a demand zone and say that this is a valid demand zone, you must do what? It must be in an uptrend. And say this is a valid supply zone, you must be what? Price must be in a downtrend, right? And we talked about the imbalance where I talked about imbalance being what price magnets, which means that they attract price to themselves, right? It's just like you understand the fact that the market is made up of both buyers and sellers, where we have buyers and sellers sharing opportunities. Do you understand? It's not partial. At every time that buyers come into the market, there are also what sellers. The money you make while buying because the market is in an uptrend is the losses of people that were selling. So money is exchanging hands. And the money you make while selling when price is in a downtrend is the losses from people that were buying. So at every time that you're buying, just know that somebody else is selling somewhere. And the market is very, very fair in the sense that it gives both buyers and sellers equal opportunities. So when he notices that, oh, okay, I think only buyers are in control of the market. Buyers have just been buying since today. You notice that it want to create a retracement so that sellers will also have a hand. Do you understand? And that is why you see that even in an uptrend where we have, price is supposed to go up, right? Even an uptrend has what? Retracements before the upward movement. Retracement, expansion, retracement, expansion, retracement, expansion. And even the downtrend when price is going down still has what? Still has retracements, expansion, retracement, expansion, retracement, expansion, retracement, expansion, retracement, expansion. So you realize that at the end of the day, in all of these market structures, there's always what a pullback for market balance. Do you understand? There will always be a pullback for market balance. You will never see a particular pair fall like this for eternity without the other side having an opportunity to speak or contribute. Okay? So which means that these imbalances, they give you the assurance that price is what probably going to return to that entry. So having these imbalances before your demand zone makes it of what higher probability. And we also talked about inducement, which I said not just any inducement, but your inducement must be what in the 50% of price leg. I already taught you guys how to mark out 50%, where I talked about using your Fibonacci tool from a swing towards a swing. So from a swing low to a swing high in an uptrend, from a swing high to a swing low in a downtrend. This is how you mark it out. And then your level of inducement must be what? Must pull back into 50% to say that, okay, this is what? A valid demand zone, right? And I also mentioned when we got to liquidity and inducement, that the best part or the best type of liquidity or inducement is a structural liquidity or structural inducement, right? Because it's the one that makes people think, okay, you already understand that every structural low is a demand zone in an uptrend, right? So when you have those lows like that, you know that, okay, it is most likely going to induce people to buy from them, right? And that's why I told you that most recent BOS before your entry is what a type of inducement. So when you have structural lows like that, you know that people are going to be what induced because it's a demand zone now. There are people they are looking to demand to buy that particular asset at that level. All right. So that's like one of the best type of inducements. Even when we did entries, I mentioned that the type A type of market structure is what better than the type B type of entry. Type A entries are what better than type B entries, right? Because the type A they have what structural liquidity. And even when we got to the liquidity and inducement, we treated what the equal lows type of liquidity and inducement. The price place was a series of equal lows and then what takes it out. Because at equal lows, most people that trade retail, they are looking towards sell. They're looking to buy, sorry, and at equal highs, they're looking towards sell. So they have their stop losses resting above those levels. That is money. I told you that liquidity in simple terms means what? Money. If anybody asks you what liquidity is, just say money. All right? Why inducement means what? Deception. That is how to understand the two of them easily. So when people set their stop losses above levels, there's liquidity resting at those levels. And that is why price is what always attracted to this liquidity. It needs it like a fuel. So it takes it out and then continues what in the intended direction. All right. So you're trying to make sure that these areas of liquidity that price is going to target will be what's below your entry when you're buying. Sorry, above your entry when you're buying, and then below your entry when you're selling, so that when price takes it out, it mitigates you and does what continue in your direction. And when we got to entry types, we treated what the two type of entries, or we talked about the type A entries and the type B entries, where I illustrated that what the type A entry just looks like this, where you have price sweep, break structure with the same movements, then give you a pullback into 50%, break structure again, then pulls back to the other block and what buys. This is our typical. Sorry, I think this is a bit slanty. I don't like it. Right? This is our typical type A type of entry, just like this. All right. And then we have what? We also have type B. Type B is like of lower probability than the type A, where price actually gives you what? When price actually gives the structural inducement before breaking structure, then pulls back and then what? Buys, just like this. This is what the type B market structure looks like. And this is of lower probability because I told you that that having most recent break of structures as liquidity gives you what higher assurances that people are what's going to look to buy at this type of level. There are higher chances of people looking to buy at this level than there is of people what's looking to buy at this level. So this is always of higher probability than this one. And we also treated what risk entries and confirmation entries, where I taught you that when it comes to confirmation entries, we have two types of confirmation entries. We have what? The candlestick patterns and the pattern confirmations. For the candlestick confirmations, we have the pin bar, the hammer, we have the bullish and the bearish engulfings, and we also have what the dodgy reversal candlesticks. If you remember the class we had on candlesticks, we treated silver candlesticks, but I emphasized on the power and the powerful and the important candlesticks. You know, I told you guys that when it comes to important, the engulfing candlesticks are very, very important. You see, for demand and supply zones, I told you how to mark out demand and supply zones, right? Where I talked about that if you have to map out a demand zone, you're mapping out from what? From the engulfing level. Let's say now there's a demand at this level that I want to mark out. What do I do? Let me expand this for people watching. All right, there's a demand zone at this level now that I want to map out. What do? I map out from the top of the small candlestick then to the low of the lowest candlestick, whether it's the bullish or the bearish candlestick, the lowest one down there, the top of the smallest one to the low of this one, just like this. And then I extend. This is how to map out the demand level, right? So you notice something like this now, mapping out the demand level like this now, you're mapping out using what? The bullish engulfing candlesticks. They are the most recognized type of what? Demand levels, candlesticks for demand levels. And if you're going to map out what a supply level like this now, you're going to still what? Use the bearish engulfing what? Candlestick. Let's say this is a supply level now at this point. What do? You're going to map out from this now. You can, depending on how big it is, if it's a very big, don't worry, I think with subsequent classes, maybe not one, the weekly sessions I'm going to be having after this support curriculum, I'll try to be chipping most of these things in so that it is as you're practicing or as you're executing already that these things start coming in, especially the TPO, right? I don't think I would want to include it now until you guys are already executing properly. Okay, but then let's look at something like this. Now, if I'm to map out the demand zone like this, you can map out from the week if you think this is not too big for you, right? Forget about this thing that happened here. So something like this now can be a way to map it out. If you still want to remove the wick and just use like the candlestick body, this is also another good way to map out what your demand zone. Just like this, just like this. But you see that what the emphasis is on what? The bearish engulfing candlestick. So I told you that the engulfing candlesticks are very important candlesticks because these are one of the things that they can be used for marking out what our demand and supply levels. And at the same time, they are also what part of our confirmation candlesticks because I established when we were doing candlesticks, I told you that when price creates what bullish engulfing candlesticks, what do you see? You see what higher prices. Like you can see here now, this bullish engulfing candlestick was created, right? And you can see price was moving to the upside. When this bullish engulfing candlestick was created, you can see what we experienced was higher prices. Bullish, okay, this is not a bullish engulfing, but then this is a bullish engulfing. You can see what higher prices. So seeing this bullish engulfing candlesticks, you can see here now we had what this bullish engulfing and we experienced what higher prices. So seeing this bullish engulfing candlesticks before your entry, on your entry when price mitigates your entry, it's a confirmation candlestick that price is what's ready to continue bullish. It's a good confirmation candlestick. All right. And when you see bearish engulfing candlesticks on your supply zones, they also what good confirmations that price is what ready to continue bearish. Like if you look at this point now, we had what this bearish engulfing and you see what price was lower price. Most of the times that you see bearish engulfings on charts or bullish engulfings on charts, price is what experiencing downside movements for bearish engulfings and upside movements for what bullish engulfings. All right. So these are what one type of what our candlestick confirmation, the bearish engulfings and the bullish engulfings. The other one is what the doji candlestick. I told you that when it comes to candlesticks, the doji candlesticks are the most powerful. Engulfings are the most important, yes, but doji candlesticks are what the most powerful. They just look like you see how we have change of character in market structure. The doji candlesticks are like the change of character of candlesticks. They reverse structure. So you can have price creating bearish candlesticks and then the doji just shows up and price starts what becoming bullish. Or price is coming bullish and the doji shows up and price becomes what bearish. So when you have like a demand zone like this now and price is retracing to your demand zone, you know this retracement now is going to be a bearish type of retracement. Price coming to your entry like this is going to be like in a bearish way. So something like this occurs now. Is creating series of what bearish candlesticks. Okay. Now when price gets to your entry and gives you what a doji candlestick, it's showing you now what there's now what a bullish reversal, or you're anticipating what a bullish reversal. So having a doji candlestick on your entry is showing you what a reversal, which is a good candlestick what confirmation type. And then the next one that we talked about, I think the doji, the engulfings. What other candlestick pattern did I talk about? Okay, the hammer and the pin bar. You already understand how beautiful the hammer is. The hammer is just made up of what? Series of rejection, like a proper rejection candlestick is the hammer. When you talk rejection, you talk about what? Hammer. So if you have a demand zone like this, and then price comes to your demand zone, just like this, creating what? The hammer. You can see, in fact, no need of looking too far. This is what an example of a hammer candlestick. All right, this here is an example of the hammer candlestick. You can see the way this candlestick mitigated this entry, and then price what created this hammer. This hammer shows you what a clear rejection that this place people are buying. They are what buy orders to the upside. You understand? So it's like a bullish candlestick, a proper bullish candlestick. You can see when you see something like this on your entry now, you know that okay, this is what a good zone to buy from. There is what buy volume on this zone. Price mitigates and what continues to the upside. This is a proper bullish confirmation candlestick, right? Why for the pin bar is for the downtrend. It's just like the opposite of what the hammer candlestick. It's just like a rejection candlestick. When price mitigates your entry and then you see the pin bar candlestick, it's just giving you this, okay, price is what? Like if you look at something like this now, let's say we had what a supply zone at this level, all right? You had a supply zone at this level. You can see what? You can see this mitigation to this zone, this particular mitigation to this zone. You can see the rejection. This is a very good example of what? This is an example of the pin bar. You can see the rejection down to the downside. It gives you the confirmation that okay, sellers are on this zone, people are selling on this zone. All right, so that's our candlestick pattern for confirming a zone, right? The hammer, the pin bar, the bullish, the bearish engulfings, the what doji candlesticks. If you're not still clear on how to recognize these candlesticks, although I think I gave examples, I gave assignments when we did candlesticks and asked you guys to identify these things. Then, right? You can see how important they turn out now at the end of the day. All of these come together when it comes to putting these things together. You're definitely going to need every knowledge that you've acquired so far. And then when it comes to the pattern confirmation, I told you that the pattern confirmation is just like the one that you've done before, which is what the normal confirmation candlesticks. All right, price comes to your entry, and then you look out for the same thing, just like price comes to your entry, and then the pullback is going to look like this series of what lower highs and lower lows, and then you anticipate that price takes out this lower high just like this, and then gives you what our normal model, whether type A or type B, or even reclaim opportunities, right? And then I also mentioned that not just the type A and type B that we have, that's the type A and type B type candlestick types. I also mentioned that entry types. Also make sure that we can use what reclaim blocks for entries. Reclaim blocks are even high probability entry models because they are what the oldest or eldest brothers when it comes to what the hierarchy of PD arrays. All right. Now I talked about reclaim blocks. I said that if a reclaim block is being created by an invalid order block, just like this, let's say another block that does not meet your criteria is what is creating this reclaim block, meaning that another block like this is being filled. What do you need to do? You need to anticipate a form of liquidity before your reclaim block, before you buy from it, just like this. There needs to be a form of inducement. You see this inducement level, all right? This is pattern 1, a reclaim block being formed from the failure of an invalid order block. Needs a form of inducement or a form of liquidity to be a valid zone to buy from. All right, something just like this. And then the second one, which is the one that is formed by the failure of a valid order block. I mentioned that it doesn't necessarily need to do what? It doesn't necessarily need to create a structure. Let's say something like this. Now, this is a valid demand zone now that we have at this level. And then price does what? Price takes out this demand zone. I mentioned that something like this now, if price rejects, you can what? You can buy from this level. All right. You can buy from this level now. You see the difference between these two, they are both reclaimed blocks, but the difference between this one and this one is that this was created by what? The failure of a valid order block. Right? This one was created by what? The failure of an invalid order block. So this one you need to wait for what? A form of liquidity, a form of inducement. But this one, right, you can what? Straight up buy from the reclamation. All right. So what else again? So for today, I want us to take putting it all together and then targets. All right. So let's look at I think there was a pair I was marking out. That's EURCAD. Before then, there's a trade I'm currently on. I don't even think it has moved anywhere. It should be EURAUD. I want to show you guys an example, of the pattern confirmation that I was talking about. Now this is okay. This is a trade I'm currently on, just triggered. But then, if you look at what I was talking about at this point now this is a demand zone at this level. All right. And if I should map out from this level to this level, which is the first swing low to the second to the swing high, that's point here to point here. All right. You're going to notice that the form of inducement actually put back into 50%. Here you have what? A structural type of inducement at this point. Actually put back into 50%. And then price came, mitigated the demand zone. You can see here the price created what? This low, mitigated what? After creating the low, what happens? It created this lower high and then what the next lower low. And I told you when it comes to pattern confirmation, what do? You anticipate that price takes out this high and then does what? You can see that price came, created this low, then this high, then something just like this. All right. So using this area now, this level what as my inducement, more like equal lows at this point. This is what my level of confirmation. This is the sweep, right? So this is where I'm looking towards take my confirmation entry on this demand zone. This would have been a valid demand zone to take a buy from, right? But then the fact that there is what a clear inducement below it and there's no proper sweep before this demand zone, all right, it wouldn't have been good enough for me to take what a risk entry on. Instead, the confirmation looks what way better, all right? So back to EURCAD, which we'll be using today for our putting it all together. Now, the first thing when it comes to putting it all together is the structure. That is why I tried to run through everything we've done so far before I start, right? The most important thing is the market structure. Very important because I told you that when you're able to um, get yourself on the right side of the markets, you've solved what like 60% of your technical analysis problems. When you're buying, when the market is buying, or when you're selling, when the market is selling, right? You've saved yourself like 60% of stress when it comes to what technical analysis. So the first thing you want to do is to what is to get your structure right. All right. So the first thing is get your structure right, which is like going towards probably the 4 hours time frame, which is my most recommended time frame when it comes to day trading. You go to the 4 hours time frame, you mark out from your swing high to your swing low, from your swing high to your swing low to determine okay if price is what in an uptrend or if price is currently what's in a downtrend or if price is what's currently ranging. But you have to be able to establish that okay, price is buying or selling that day. So to establish your directional bias, you need to what interpret structure, higher time frame, 4 hours time frame. You go to the 4 hours time frame first, you mark out oh buy, sell, like something like this. Now this is the 4 hours time frame on AURCAD. Let's see. Sorry, I think my network is a bit poor. Okay. Right. So this is a 4 hours time frame for this for EURCAD. All right. So the first thing you want to do is see, okay, what is the 4 hours time frame doing? Are we buying or are we selling? Like currently, let's say you have met price as at this point now. Let's say marking our structure from this point now. You have what structural lows and highs, higher low, higher high, higher low, higher high, higher low, higher high, just like that. And then price takes out what this higher low, right? Giving you what a change of character. But I told you that a change of character needs to what? A change of character needs to break structure again for you to confirm that what it is a change in trend, which in this case did not happen. Instead, President had to do what to establish a new high, which means that we're very bullish, we're still bullish. So if you establish that the 4 hours is bullish, the next thing you do is to jump down to the 1 hour time frame. Right? Now on the 1 hour time frame, this is where you start with anticipating or start looking out for your entry models, right? In this case, now this was the EURCAD that we used for last. I think the very last class we had on entries. This was a trade that I analyzed was saying that last. I think I showed you guys the result from Nelson as well, right? This was for one of the trades that he took. If you look at something like this now, when you come to the chart, you're like, okay, at this point now we have a low, we have a high, we have a low. Look at what happened internally. We had price take out this low to put in what? A sweep. We had price sweep this low. And after that sweep, what happened? After the sweep, price went ahead to do what? Put in a new high straight up. And if you take your Fibonacci 2 from the low to what to the high, you would realize that there was a pullback. You realize that there was a pullback into 50%, and then price went ahead to do what? Establish a new high. Giving us what? Our type A type of entry. And then when you mark out something like this now, you go back to the 4 hours time frame to see, okay, this thing that I've mapped out, let me cut price from here. Cutting price from this level, just like this. Sorry, I think this is going to be a bit slow. Maybe network issues, but shouldn't be. The phone is ringing. And then you go to the 4 hours time frame after having an analysis like this. You see, okay, what I'm doing, is it in line with what price is doing what on the higher time frame? If you look at this is what you mapped out on the what on the 1 hour time frame. And so I mentioned that what you go to the 4 hours time frame to see if what you're doing is, sorry, I want to take out my drawings. Let me go back to the 1 hour first before I continue. All right. Okay, so you don't make an analysis like this. You're looking to buy what at this level. You have your sweep, your break of structure, your inducement, your type A entry model, all right? And then you're done marking out something like this properly on the 1 hour time frame. Now, what's the next thing you do? You go to the 4 hours time frame to validate that what you're doing is in line with what price is doing on the 4 hours time frame. Now, if you look at the 4 hours time frame, you can see that here on the 4 hours, we had what a demand zone that price is currently what reacting from, right? We have a demand zone that price is currently reacting from, and then price mitigated that demand zone, mitigated the demand zone, and actually gave us. Please, can you close the door properly? Okay. Price mitigated that demand zone and actually did what? Gave a type B type of entry model, right? There you have the pullback before price finally broke this level, right? The pullback just like this, and then he pulled back to mitigate this confirmation level, right? This was the confirmation level that was mitigated. So you had price do what? Come, create a low, then does what? Mitigate this confirmation level. So let's say now that okay, you were able to catch the confirmation, that's the pattern confirmation on this trade. It would be what on something just like this. All right, if you're able to catch what the confirmation on this particular setup. But then for people that would have not been able to catch it or would have been skeptical about it, what happened? Price gave what another re-entry. That's the beautiful things. Most of it, then I told you that most of the types of currencies, we're definitely going to see what pattern confirmations. That's why sometimes you can be on a trade and then you have price do what price mitigate the trade and then pulls back into the trade to give what a confirmation before continuation. That happens as well. All right. Now for something like this, now you can see that this confirmation level now what happens? Price sweeps the price sweeps this low to mitigate that confirmation. But then after that sweep, what do we have? We experience a surge to the upside and then a pullback here this year. You realize that what is happening on the 1 hour time frame is very in line with what is happening what on the 4 hours time frame. Price is actually what's very bullish on the 4 hours time frame. And then you go back to the 1 hour time frame and you click on what you've already input your buy and your sell to just like this. The next thing you do is to properly execute. There's nothing holding you back. This is in line with your what with your 4 hours time frame. You have what your proper inducement. This is the structure on the 1 hour time frame is also proper. Your type A entry model targets met. You have validated your demand zone with your 6 validations. That's your BOS, your trend alignment, your imbalance, your structural liquidity, your premium and discount, and then your sweep of market structure. Everything met. The next thing you do is ask yourself now, where is this setup coming from? Now, in this case, you can see that what this setup is not coming from any supply zone. This is what still very bullish. After all, price is what's going to be targeting to take out this previous high. This is a higher high. This is the previous higher high that we have. Highs that you're anticipating that price takes out. All right, it's very different from when you have a demand zone like this at this level, and then price is what's trying to sell from a supply zone. Let's say you have a supply zone just like this. Let's say you have a supply zone just like this. That price was does something like this to mitigate. Now, before the mitigation, you might have what created like a type A kind of entry. Let me see if this was illustrated properly. We'll pull this back a bit. Okay, let's say we have something just like this now. Price creates what? Okay, price creates a type A entry model at this point now. All right. Now, for something like this, now you wouldn't be looking to buy at this level if this mitigation is from what a supply zone, because most likely you now understand that something like this now, price is what it's reacting from a supply zone, which means that for now what price is what bearish. Do you understand? Looking for these entry models in opposite market trends can make them what invalidated. So when you're trying to validate it or putting everything together, you have to still pay attention to the trend. Where is price coming from? All right, where is price coming from is a very important question that you ask yourself anytime you make an analysis. All right, for this one, you can see where what price is what's coming from a demand zone. Price is what bullish. Where is price going to as well? Price is what going to be targeting the previous higher high. This is a bullish trend. And then playing market structure, we're going to see that price came with let me increase this to 10x. Price came with speed, took out the structural level. It kind of created like a relative equal low, was ranging, engineering liquidity, and then finally did what swept that level, mitigated. Now on mitigation, I want you to notice the type of candlestick that was formed on mitigation. Can you recognize our hammer candlestick pattern? That was what our rejection candlestick on this level. Price came, mitigated the entry with what the hammer confirmation candlestick, and then what continued to the upside, putting what a new high. All right, price came, took out that point, took out this internal high, and then finally, I think at the end of the day, price has what been able to successfully take out the previous higher high. Remember, yes, price coming from and where is price going to, right? So you can see your hammer candlestick pattern at this level, and then finally price has what taking out this previous high. This particular pair is still bullish, and as price is still proceeding, as price pulls back into the discount, you can still look out for more continuation patterns to continue the uptrend until this finally gives you a change of character where it takes out the previous higher low for you to know that okay, this is now um unconfirmed bearish, and if it gives you an extra confirmation, you now know that this is now a bearish market trend. So this is how you put this thing together. First of all, your market structure marked out on the 4 hours. On the 1 hour, you try to recognize your entry models, and then you go back to the 4 hours to validate it. Where is price coming from? Where is price going to? Even if you look at this, I think these ones are in the retracement. These ones are in the retracement phase. I think. Let me see. Okay, yeah, for something just like this now, we had price coming in an uptrend. This is an example of the reclaim blocks. All right. But then if you look at this now, this particular reclaim block was formed by what? It was formed by an order block that was more like the inducement here did not pull back into 50%. If I should map out from this to this low, it wasn't a proper pullback into 50%, right? So you can see that price came and swept off that order block. And I told you that we were trading other blocks like this that look like they were formed by, I'm sorry, we claim blocks like this that look like they were formed by invalid order blocks. You need to see what a form of inducement before price mitigates. In this case, now you can see this level. This is what a proper inducement level now for this zone. And you can see that price swept it, mitigated, and sold. It's part of the pattern I taught you when I said reclaim blocks being formed by invalid order blocks. That's an example. And if you look at what I have here, when price was coming, that was the retracement leg of this particular pair, or that's the ERCAD on 1 hour. Here you had price coming in an uptrend series of higher lows and higher highs, higher lows and higher highs. And then what happens? Price took out a previous higher low at this point. This was a higher low that price swept, right, at this level. Now taking out that higher low and then going ahead to do to create another break of structure after the higher low was swept gives you a confirmation that price is now bearish, and also coming back again to do another break of structure tells you that price is now bearish. So something like this now, if you look at mapping out from year to year now, you have this particular inducement level pull back into 50% of this leg. You have your sweep, you have your pullback, and then you have your type A typical type of entry. All right, this is like a type A type of entry. And even for those of you that wouldn't have considered this as a pullback, although it is a pullback though, like for teaching's sake, this is actually a valid pullback here. All right, I told you that pullbacks can be formed by three proper candlesticks. This is not insignificant. This is a valid pullback. But even if you're not considering that level as a pullback and you decide to mark this whole point as let's say this is the point you want to consider as your change of character, right? You still notice that even mapping out from this level to this swing level, that's this low here now, we have we still have the inducement level pull back into 50%. So whether you like it or not, this is our typical type A entry model. And then what happens? You set your analysis. You go to the 4 hours time frame to ensure that this thing that you're trying to sell is in 4 hours premium. So that if you're trying to buy, you're ensuring that it's in 4 hours discount. But if you're trying to sell, you're ensuring that it's in 4 hours premium. So this way you're doing from down to up. All right, 1 hour to 4 hours instead of 4 hours to 1 hour. But you realize that the 4 hours leg, before you see too many demand zones like this, it will take a lot of time. Like, in a month, you can have only like two valid, maybe more than two demand zones can be created. Or you can have like only two valid demand zones created on 4 hours. But you have multiple things going on the 1 hour. So that's why I talked about what using the 1 hour to map out these entry models and then validating them out on the 4 hours time frame. When you have something as beautiful as this, what do? You set your entry and you what target a targeted low. Remember, I told you guys that the lows in the downtrend are what's targeted, the highs are what's protected. Although with subsequent classes as well, I'll try to chip this in when I talk about the targeting next demand zones. You can target next demand zones, you can target next supply zones, but in cases whereby price is not showing you a next valid demand zone or a next valid supply zone, then you cannot target what's the previous lows and the previous highs, because you understand that for an uptrend now to continue, price needs to put in a new high, meaning that the previous high will be taken out. So you can target that previous high because you have the assurance that price is what's going to put in another high. So in the process of price putting another high, that's your target on the previous high is going to be what hit. In the case of a downtrend, you understand that what the lows are targeted, meaning that price has to put in a new low to continue in a downtrend. And since we have established that what this is a change of character and a confirmation, meaning that this is a downtrend, for price to continue this downtrend, we want to see it do what take out a targeted low, which in this case is what this low. Price has to take out this low and continue what's in a downtrend for us to see that this is a downtrend. So what happens? You have what your target is what at the targeted low, just like this, anticipating that what price takes it out in its quest to put in what another low. You can see that price took it out to put in what another lower low, just like this. All right. So you target lows like this. Well, in the cases whereby, let's say you're trying to sell from here now, and then you see a valid demand zone that meets your criteria. Right. Let's say now there was a valid demand level at this point, which there's no valid demand zone here, but let's say there was a valid demand zone at this level. Instead of targeting this low now, you're going to what? Just place your target just before the demand zone, just like this. All right. Most of the times, this particular type of targets are usually used when you're counter trending. Let's say you want to sell to a valid demand zone, like price is an uptrend, but you want to catch a retracement to a demand level. All right. Your target is going to be just before what? Just before the demand level, just like this. And then you can also target areas of liquidity, like in case like this now, you don't want to target this low. All right. You don't want to target this low. If you look at this point here now, we have what? We have equal lows at this point, and you understand that at equal lows, what happens? At equal lows, you're anticipating the price will take it out because what? There are people looking to buy at those levels. So there's what liquidity resting above it. So if you have liquidity levels like this, what do? You can place your levels on them. Since you understand that whether you like it or not, price is what definitely going to what take them out. You can see the way price took out this liquidity level. Yeah, at this point, price came, mitigated it, and then what? Took it out just like this. So targeting areas of liquidity like what the equal lows, the trend line liquidities, and the structural liquidities. Even when you're counter trending just like this, let's say you're counter trending, and then maybe let's say you're trying to counter trend something in this area, right? And then you're already selling from this point. The target can be what at a structural liquidity just like this, because you understand that for price to mitigate this value demand zone, they has to take out the structural liquidity. All right, something just like this is what So your targets can be what areas of liquidity, because you understand that price to take them out and continue in your direction. Like this point now, without equal lows that we targeted, the target can be what the lower lows or the higher highs, because you understand that lower lows are targeted lows and lower and higher highs are what targeted highs, because price has to take them out and put in new ones. So for price to continue a downtrend, it has to take out this low. So if this liquidity level was not here, this would have been what a proper target level. All right. Or if there was a demand zone at this level now, your target would be what just before the demand zone. So this is how you place your targets. All right. Areas where you're not anticipating what reversals. And if you look at what happened on this level as well now, this is a demand zone that did not meet any of your criteria. All right, this is a demand zone that would have not been valid enough. Why? You can see the fact that it was just what a break of structure and a form of what engineered liquidity at this level. All right, price just broke structure and continuing the trend. And then this particular imbalance would have been what made you skeptical because price can will take out this level to fill this imbalance. All right, so this demand zone was not invalid at all. Was not valid at all. Sorry, to take a buy from. And as you can see as well, there was no proper sweep. Okay, there was no proper sweep. So this would have been what an invalid demand zone to take a buy from. But then I told you that what you can look at what these demand zones create for you, which in this term is going to be what a confirmation. And you can see that as price mitigated the demand zone, what happened? We had what the pullback to the mitigation was creating a series of lower lows and lower highs, lower lows and lower highs. And then what happened? This was what a lower low. And this lower low actually did what? It swept this particular point. There was a sweep here before price did what? Did something like this, pulled back, and then went ahead to what? Take out the previous high at this level. And then we have what is sort of our type B entry model. All right. But then if you're using this level as your break of structure, it will be what a type A entry level, right? So which means what you're looking to what take your confirmation from this level, and then price pulls back into that confirmation and what continues buying. So that's why I told you that what you can look at what invalid demand zones create, right? Levels where you're unsure of what happens, you just anticipate confirmations on that level. I'm so sorry, this is above 10 o'clock already, but I hope you don't mind. Let's continue. All right. So you can look at levels whereby price mitigates previously, and then what take pattern confirmations on them. Pattern confirmations, candlestick confirmations. Your candlestick confirmations can be like the hammer, like you can see now. Here we have what a hammer candlestick for what rejection. All right. This is an invalid order block creating what a valid on re-entry just for you. But preferably, if you're using pattern confirmations, I prefer that they are being created by what? By valid demand zones. So here now again we have what? A valid type of demand zone where we have price day what? We had a sweep at this level. This is just for example purposes. I think this whole structure was even bearish. All right. Now we had price take out this level. We had price dot put in take out this level as well. And then what happens next? We had what another break of structure at this point. Now at this level here, now price did this after this before this level was this, we had this particular inducement before price actually broke out. So this is like a type B, not a type A type of market structure. Remember that the type A is the one that pulls back. The price does not create the inducement before pulling out, right? And then here you have what your type B entry model. And you can see that when price mitigated the type B entry model, what does it do? It continue what to the upside. In cases just like this, you would have what if you're looking at candlestick, if you're looking for candlestick confirmation, you can see that what price created the hammer confirmation or mitigation to show you that okay, this is what a valid zone to buy from. And I told you that in cases like this, you can what target the previous highs. All right, you can target what the previous highs just like this. Or if you're trying to be careful, you can what just target at this point, this level whereby it looks like there's a what supply at this higher high. Although it's a higher high, so your higher highs are targeted and they will be what they will be what taking out. But to avoid price retracing, you can just what place a target around this level. With time, when you start executing, you get used to what placing targets. Okay, so let's continue. Now, yeah, as well. We had price. This is a counter trend here. I just added this because of the fact that it was there was an example to show here. Do you understand? If not, this whole market structure was bearish. All right, this was a counter trend, but then I wanted to emphasize on the fact that this is a type of market structure. All right, now you can see at this level now we had what a sweep, whereby price went ahead to do what break structure, pull back to create what this particular structural low and then structural high, and then you can see what I came back to mitigate the entry and continue. For those of you, as time goes on, you're going to get used to trading this both in line with the trend and even as counter trades, right? You're going to get used to this thing. So if you look at this now, this is the counter trend pullback to mitigate what this valid supply zone, just like this, all right? But then it's still what the same pattern every time. Same pattern what every time price mitigates and what continues. And if you look at this level now, this particular supply level, which is what the one that is in line with the actual trend, we had a sweep of market structure, and what we had price give us our structural liquidity before the break of structure. Actually, it was more like a type B until what and you can see that when price was approaching entry, we have what a form of liquidity at this point, which is what our equal highs liquidity. And I told you that when you see equal highs just like this, what should come to your mind is that what price is going to take it out. So seeing equal highs just below your sell entry gives it what higher probability that okay, price is what's going to what take this level out. And you can see the way that price swept it, gave us our pin bar candlestick for confirmation and does what? And it continued selling like down, down, down to put in what a new lower low just like this. And even if you were not comfortable with this particular run, you would have been able to what, catch a confirmation entry because you can see that after price mitigated our entry, it gave what a type B type of market structure. Look at what happened. This was the mitigation to entry, and then we had this type B movement before what, the break of structure, making this what a sweep of structure. The sweep of this equal highs was a sweep, all right, making this a valid zone to take what our pattern confirmation just before the type B, right? This was our proper pattern confirmation, just in case we're not using what the pin bar candlestick confirmation. So a zone like this where you are unsure, this is what a proper pattern confirmation on that zone to catch what the sell to the downside, right? Just like this to the downside. So even if you missed out on this initial move, you wouldn't have what missed out on the confirmation. That is how beautiful these confirmations can be. They are actually what beautiful. They can serve as what the entries. All right. Pattern confirmations, candlestick confirmations, and I think I still have something mapped out here now on now if you look at this here now for the mitigation, you can see that what we have our hammer candlestick. All right. That's why I told you that when you finish analyzing and price mitigates your entry, if you're going to be using candlesticks, all right, when price mitigates the entry, you're looking out for what either engulfings that close above your entry, or you're looking out for what doji reversal candlesticks that close above your entry, or you're looking out for what hammer or pin bar, depending on the trend, hammer for uptrends, pin bar for downtrends that close what above your entries. In this case, now you can see what this is the hammer that closes above what entry, telling you that okay, there's buying pressure in the market. Something like this on your entry now gives you what confirmation. You place your buy your market order, and what happens straight to what take profit target. You will straight above it, just like this. Where is your target? Previous what higher high. You can target internal highs as well. Most of you, as time goes on, you're going to what switch um your trading plan. Some of you will be targeting 1:5, some of you will be targeting 1:3, some of you will be targeting 1:7, whatever. But the most important thing now is what to be able to start executing properly. Then you have something to form your trading plan with. All right. And then here you can see what that there was a sweep. Price was in an uptrend at this level. We had what a sweep, and then what happens? Price does this, then comes back to give us what a structural liquidity, and then what puts in a high. Then we map out what this point as our type A entry model, and then what happens? Price mitigates and what puts in a new high, just like this. So if you realize these models, they have a very good win rate. Honestly speaking, I'm telling you, they have a good win rate if you can just align them with what price is doing in the higher time frame. And even this, so there's no need for forcing it. I told you now, this is just AURCAD. All right, this is just AURCAD. If I should, this were the pairs I looked out for last week. I looked out for my trading strategy last week. I think this was sorry, last 2 weeks. This was my last week trading list, and you can see that I have what all the pairs when it comes to currencies on my trading list, and I think like two cryptocurrencies. So like there are a lot of pairs to look out for this one. So there's no need even forcing on one pair at all. When you don't see something on AURCAD, you can go to GBP USD. Try to look out for this pattern. If you're patient enough to wait for this pattern to form in the right way, you'll see that you're going to be caught down on your trading losses, those avoidable losses, not forcing the sweeps, not forcing the inducements, allow the inducement to pull back into 50%. You find out that at the end of the day, you start taking quality trades. I told you guys, you saw my students at last, they usually drop their analysis before it plays out. That was the standard I set for them. Although they're private, right? I usually make sure that they drop it before it plays out. And you realize that I'm even able to track their profitability. In a week like this, now you can have 5 good setups and then 4 of them plays out. It doesn't have to be 5 over 5. If you can do 4 over 5, 3 over 5, you find that at the end of the day, what you're profitable. All right. It can be that okay in an entire week for the pairs you checked, you found only what 3 trading setups. If you're able to have what 2 quality ones out of the 3 of them, it's a good thing. All right. So you need to, instead of looking for better quantity, like executing 10, 15 setups with 3 or 4 good setups, even 2 setups. For me, I'm telling you, there are times whereby in a week I trade only 2 times. You know, so long as those setups are what quality ones, you wait for them to form. There's no need for anything. As a matter of fact, these things always. You will definitely at least you cannot go 5 days without seeing a trading opportunity. And even if you don't, you can't go another 5 days without seeing. All right. So all you need is, as much as we're doing this technical aspect, you need to also control yourself to be able to follow on what we're doing properly without will I say negotiating. All right. Oh, this is almost pulled back into 50%. Or I know that Star said 50%, but this is almost 50%. Let me just execute. I'm looking for money. There's one Robinson guy that I'm always noticing on Telegram. There's no day that boy types without saying, I'm looking for money, set up. You need to be patient enough to allow these things. Don't just allow your family problems blind your eye to what the chat is actually saying. All right. So just keep your mind open at all times. Now, what I would like you guys to do for me is to go back to your chat today. Now, from today onwards, you're allowed to start sending your setups with your buy and your sell to whatever, like all those things that send you to the red room. In regards to just this one, no, I don't mean disrespect to the admins and all of that. All right. Now, today you're allowed to start looking out for this point of interest, these entry models, and all of that. I want you to go back to any currency pair. These are most of the pairs for newbies, right? These are some of the currency pairs. Maybe after the class, you can just be posting and be copying. All right, these are some of the currency pairs. I know this XRP and Solana, the rest of them. The rest of them are currency pairs. You can add some of them to your watch list and then try to you can add some of them to your watch list and try to use them if you're practicing. So after this class, I want you guys to start looking out for these type A and type B entry models. All right, start recognizing them. Go to your charts, currency wise, start looking out for these things. From tomorrow's class, by God's grace, tomorrow is Wednesday, I'm going to be meeting by 9 p.m. We're going to start stacking at specific points. So we're going to move our attention, I think, for the next 2-3 classes to synthetics. All right, let's treat synthetics. So far we'll be doing cryptocurrencies and the forex currencies, for examples. All right, so we're going to start stacking at specific points on synthetics. So I may give it a break, maybe the class on Thursday. That's if we're going to be meeting every day until then. I hope it's not just overwhelming though, but I would like us to start stacking tomorrow. I'll just speak with the admins and then I'll get back. All right, but then our next topic is stacking at specific points. So please don't forget to go back to your charts to, try to look at these things, try to put it all together, whether previous past action, whether you want forward testing. I'm a very big fan of forward testing, something that I know. Let me see it in real life analysis. You understand? Let me see it in like real time. As price is creating it, let me just see what happens. You don't have to execute. Just mark out and come back to see what happens to those levels that you trusted. All right, the money does not have to be on it yet until you think, okay, you have a win rate good enough to start putting money on all of these things. All right, so I need you guys to be as serious as you can be. Don't forget the reason why you came here in the first place. Don't forget to study. Don't forget to go through all of this. All right, and then please watch out for the announcement group. Series of announcements will be going on up and down these days because of the way that the classes are now a bit shaky. But if you have any question at any point, feel free to drop them on the question group. I know that there may be questions from this particular class, so you can drop them on the question subtopic, and then I'll try my best to go through all of them and drop your answers before midnight. In the meantime, take your results until we meet again. Stan, you can end the recording. Thank you so much for joining.